So what are futures and how do we practically use them to trade? First off, a fundamental definition of futures. Futures are a contract agreement to buy or sell a specific commodity at a predetermined price and at a time. And so examples of these can be oil futures, soybean futures, wheat futures, and there's also cash ones like the S&P 500 futures. And so what we're going to focus on in this video is the S&P 500 futures and the practicality of actually trading that. If you're wanting a more fundamental definition of how futures work, I'll put a link in the description below to Investopedia, and they have a really good definition and explanation on how futures work for trading something like oil or soybeans. So when you buy an S&P 500 future, let's say somewhere here at 3,100, you're speculating that the underlying commodity, in this case the S&P 500, is going to go up in the future. And so if the S&P 500 index goes up from here, your contract should also go up in value. Sometimes there can be a slight value difference. So for the sake of actually trading this S&P 500 futures, we're not buying a share of the futures here. We're buying a contract that holds that value that we got in the market at. So if we buy a futures contract at 3,100, we're not paying that numeric value of something like a share. If this was a stock, you would be paying $3,100 for one share. For this futures contract, we are not actually doing that because we are buying a contract or a derivative on this market. We are paying a different price. And we don't actually pay or give someone money to actually own the contract. We put up something called margin, which is like collateral to essentially get control of the contract. And so margin per contract can be different from broker to broker. And there'll be things called like intraday margin and overnight margin. And so brokers will have different values of margin that is required to trade the S&P 500 futures. And also different futures will have different levels of margin. But for our purposes with the S&P 500 futures, the normal overnight and intraday margin is generally around $7,000 to $8,000 per contract. And this will be changed based on just the volatility of the market. So that can go up or that can go down. And also intraday margin can be a lot lower than the overnight margin of that $7,000 to $8,000. And the intraday is essentially the normal stock market trading hours from 9:30 Eastern time to about 4 o'clock in the end of the day when the normal stock market hours close. And so some brokers will have lower intraday margin. So the platform I normally use called NinjaTrader, their intraday margin is generally $500 per contract. And so that is so much smaller compared to that $7,000 to $8,000 that's normally at. And so this allows you to trade with a lot smaller account. So that is one huge benefit of some different brokers. Some brokers have a lot smaller margin, and then some brokers will have that $7,000 to $8,000 margin needed even in the intraday times. So if you are looking to trade futures and you don't want to have to be putting up that much margin or collateral for one futures contract, definitely look into a futures specific broker, or if your broker has lower intraday margin prices. I know Thinkorswim does have lower intraday margin requirements if you have a certain capital. Another thing that is a huge difference with futures is the actual dollar amount that you make when the market goes up or down. So because the numeric value that the market is trading at doesn't correlate with a price to actually pay for it, every point or numeric change that happens doesn't mean a one-to-one dollar to numeric change value. And so what those are for this in the ES futures, every numeric value change is called 1 point. So if you move from 3,100 to 3,101, that is called a point. And that is actually worth $50. So if you have one contract and the market goes up 1 point, your contract gains $50 in value. And then as well, the market moves in a minimum amount of increments. And so it doesn't move by a penny, it moves by 0.25 or something called a tick. And so this is the smallest movement that happens. And so this is 1/4 of a point. And so this is valued at 1/4 of a point's value. 1/4 of 50 is 1250. And so every tick in the market is going to be worth 1250. So if I quickly just come in here and buy one contract, just to kind of show you how the price movement is, here you can see here is that dollar value changing based on the market moving up by ticks and then overall points. And so every increment you can see here is essentially 1250 as the market slowly moves in or against my direction. So you can see here, it can be very volatile. Futures definitely have a lot of leverage on them. And so what happens in this trade, so essentially in your account, you have to make sure you have the margin requirement. And so let's say I have a $1,000 account and it takes me $500 of margin to buy this contract. And so what's going to happen is I'm going to put my buy order in, and the broker is then going to take my collateral or margin when I am filled at my order. And so that margin is going to be taken out of my account or put on hold, and then I'm going to get a contract. And so as the contract moves, I don't make or lose any money until I close the contract, but the broker still has my $500. And so once I close it, let's say if the market goes up a whole point and I make $50 on the trade and I close out the contract, I will then get that $50, and then I will also get the margin back from the broker. And so here you can see I'm down 75 here. And so if I closed out here, if I tried to close out here, I would be down that however much it closed down, but then I would get my margin back. And so even though my account is around $1,000, as long as I have the margin required to enter in the market and cover a contract, I can trade as many times as I want in a day. Futures don't follow the pattern day trading rule. And so you can take as many trades as you want. And so as long as your margin is covered. And so for our purposes here, again, if the market went up, let's say 2 points, and I close it out at a 2-point profit, I would make $100. And then I would also get my margin back once that closed. So I would be up $100. I would get that $500 worth of margin back. And then we would just go from there and find the next trade and enter in on that one. I can do as many trades as I want in a day as long as I have that margin amount in my account. Now, one thing to note is because you are trading on collateral and you can lose quickly the amount that you have in your account just because you are leveraging such a large amount, there can be things called a margin call. And so what happens is if you bought a contract here and let's say you had $600 in your account and it started to go against you and you got to where you didn't have enough money in your account to cover the margin amount, your broker is going to either close your trade or sell other assets you have in your account, because for them, they are the ones at risk if your account goes below $0 and you can't pay the money to take the loss on the trade. These are not like shares of a stock that you own. If it goes to zero, you already paid or owned all the value of the stock, so you can't lose any more money. But with futures, you can lose a ton of money. Essentially, the losses are infinite. And so be very careful with futures and always make sure you're trading with a stop loss. So all of a sudden the market can't move an insane amount against you in case some news comes out and you blow up your account. Futures are and can be very dangerous if you don't trade them right and don't respect that things can go bad very quickly if you are not careful. But in the grand scheme of things, futures are really awesome in allowing you to essentially day trade with a very small account. You avoid the pattern day trading rule of having to have $25,000 in your account to day trade stocks, you can definitely start day trading futures with a couple $1,000s in an account and a lot of practice under your belt once you've kind of got a grasp of futures. Now, one more thing is if you're wanting to go up in contracts, you do have to have more margin in your account. So if you wanted to trade 2 contracts and your margin requirement was $500, you would need $1,000 in your account to cover those 2 contracts. But once you close out on those contracts, you can then buy another 2 contracts. So again, just make sure you have enough margin to cover what you want to trade. But once you close a trade, you will get that money back and you can just keep consistently trading and making as many trades as you want in a day.